Hello, Super Saver. I hope you're healthy and well this week. So, we've hit the debt ceiling. Now what? What does this mean for I-bonds, T-bills, and other Treasury securities? In today's video, I wanted to address some of the top questions we've gotten on this topic after posting last week's video about a possible US default and your bonds. I've linked the video in the description below for those of you who haven't seen it yet. Here are the questions I'll answer today. What did investors do with their money in the past when we hit or were close to hitting the debt ceiling? Does hitting the debt ceiling mean that investors can't buy more new issue treasuries at auction? And am I buying T-bills with maturities past May? You guys know that I can get giddy about tables, especially tables that help me and hopefully some of you sleep better at night. Well, table and chart lovers, this is going to be a good one. So what did investors do with their money in the past when we hit or were close to hitting the debt ceiling? They bought US Treasuries, that's what. And specifically, longer maturity US Treasuries. So I have to admit, the irony of this one, the irony of people actually bidding up US debt prices when there was a fear that the same US might run out of money, it gave me a giggle as I scrubbed through all the numbers, which I'll show you in a moment. Fueled by the flurry of questions from our Super Saver community, what I did was analyze short-term and long-term treasury prices relative to the S&P 500 when we hit the debt ceiling in the 2014 Treasury fiscal year and again in the 2019 Treasury fiscal year. Both times the result was a funding gap, followed by a partial government shutdown, as you can see here. The shutdown in the 2014 Treasury fiscal year lasted 16 days, and the shutdown in the 2019 Treasury fiscal year lasted nearly double that at 34 days. Keep in mind that a government shutdown is not the same as a default by the government. In all past instances where the US hit the debt ceiling, and even when there was a partial government shutdown, the debt continued to be serviced without interruption through the crisis, and there was no default of any kind. There is one more thing to note as we go through these charts, and it's that Treasury prices and yields have an inverse relationship, meaning that when Treasury prices go down, yields go up, and when Treasury prices go up, yields go down. I could go down the rabbit hole on this one, so let's save the deep dive for another video. For the purposes of this video, understanding and remembering this inverse relationship between Treasury prices and yields is enough. I'll be mainly focusing on Treasury prices in the charts to come. So let's first take a look at Treasury prices versus the S&P 500 index when we hit the debt ceiling in the 2014 Treasury fiscal year, which was actually towards the end of 2013. The Treasury fiscal year runs from October 1st to September 30th of the following year. This yellow line here shows the price of the 10-year Treasury note. The 10-year Treasury is considered a benchmark in the industry and serves as a reference point for the general direction of where things might be headed for the markets, economy, and so on. And this gray area here shows the 16 days between September 30th, 2013 and October 17th, 2013, after the government hit the debt ceiling and a partial shutdown followed. This section represents the month before funding ended and the shutdown started. And this section represents the month after funding was restored and the shutdown ended. And this red line here is the S&P 500 index over the same time period. What this chart tells us, my financial friends, is that when faced with uncertain prospects during a US debt ceiling crisis, and in particular, as a shutdown drags on, investors have a tendency to temporarily hop out of the stock market. The S&P fell. And I can only think that this was due to the expectation of short-term financial disruption from the political instability and partial government shutdown to certain businesses and to the overall economy. And what they hop into are longer-term treasuries, because most probably they fundamentally believe in the long-term prospects of our country, our businesses, and our role for all intents and purposes as the global bank. The markets call this phenomenon a flight to safety, when investors buy relatively safer bond investments like US Treasuries rather than riskier investments like stocks in order to reduce the risk of losses during times of crises. And in this example, the markets clearly assumed that even a government shutdown would not lead to any kind of default of US debt. They simply didn't price in the risk associated with the potential for an actual US government default. On the contrary, they continued to see US Treasuries as a safe haven, and they proved correct. Because if folks believed that a government default was even a remote possibility, they wouldn't be piling into 10-year Treasury notes, driving those prices up and therefore yields down. They'd be doing the exact opposite, fleeing our debt, driving those Treasury prices down, and therefore yields up to basically make up for this additional default risk they would be taking on. And as you can see, once the debt ceiling was raised, the shutdown was ended, and things for the most part normalized, folks hopped back into the S&P 500 and presumably out of the safety of the 10-year Treasury note and other safer assets, as you can see here. For those of you who are wondering, based on our analysis, prices and yields of the 7-year Treasury note track those of the 10-year very closely as well, where shorter-term Treasuries, like the 3-month T-bill, stayed for the most part stable, with some small blips here and there. We see a similar pattern of Treasury prices versus the S&P 500 index when we hit the debt ceiling in the 2019 Treasury fiscal year. Investors temporarily hopped out of the stock market and into what they perceived as safer, longer-term Treasury securities, driving the S&P down and the price of the 10-year Treasury note up. And U.S. Treasury securities, again, proved themselves as a safe haven in turbulent times. And the markets, again, and in the end correctly, did not seem to price in any likelihood of a U.S. default. And as before, once the debt ceiling was raised and the shutdown was over, prices started to normalize again. The shorter maturity 3-month T-bill also stayed relatively stable throughout this time period. Now, I went one step further after this because you guys know I like larger sample sizes. So, I took a look at what happened during the 2011 debt ceiling crisis. Do note that we didn't actually even hit the debt ceiling, nor did we have a shutdown that time. We came close in 2011, but 2 days before the Treasury was expected to run out of money, Republicans agreed with former President Obama to raise the debt ceiling in exchange for a complex deal of significant future spending cuts. That sounds familiar, or? The reason I looked at the debt ceiling crisis in 2011, even though we didn't hit the limit that time around, is because this 2011 example is often referenced in the media as nearly catastrophic. And what usually follows is a general statement that Standard & Poor's downgraded the U.S. credit rating one notch from the highly prized AAA rating to where it stands now at AA+, all of which is true and not great. Now, theory would lead us to believe such a downgrade would drive U.S. Treasury prices down because people would sell the debt of a newly downgraded U.S. and new investors would demand a higher yield. Well, guess again, super savers. And that's why I pulled the numbers on this one to see if this was actually what happened. This blue line here, August 5th, is when Standard & Poor's downgraded us. But Treasury prices continue to climb upwards without interruption, indicating a continuing healthy demand for U.S. Treasuries and no flight from them in any way. And the S&P 500? It did the opposite, just as in the last two examples, and it lost value. And the shorter-term 3-month T-bill, it stayed relatively stable, also as in the last two examples. So what happened when the U.S. government hit the debt ceiling and the government shut down? Folks flocked into longer-term Treasuries. What happened when the U.S. government's debt was downgraded? Folks flocked into longer-term Treasuries. I mean, 1 time could be an accident. 2 times could be by coincidence. But 3 times with similar results? That's a charm in my mind because it shows a pattern. Having said that, as we always say in the industry, past performance is not indicative of future developments and returns. But I do suppose that's how the term flight to safety came to be. In times of instability and uncertainty like those that we're in now, Well, technically, it's going into year 3 of instability and uncertainty at this point, but who's counting? I digress. In times of instability and uncertainty, investors flock to U.S. Treasuries at the expense of the stock market. And that can only mean that investors do not really price in the likelihood of a default. Of course, there may also be other factors at play. There usually are. However, I think that the factors I outlined are a useful explanation of how markets reacted to the U.S. debt ceiling crises of the past. It'll be interesting to see whether the same pattern will continue this time around. As usual, I'll keep watching and reporting back on the situation as it evolves. So, what do you think, Super Saver? Was this flight to safety what you were expecting? Drop a comment below and let me and the other Super Savers know. The answer is investors can continue to buy new issue treasuries at auction for now. If we go to Treasury Direct's upcoming auctions page, at the time of this taping, we can see that it's currently still business as usual, which of course leads to the question, well, if the government hit the debt ceiling, how can they issue new T-bills, notes, and bonds at auction? Here's how that works in principle. When the U.S. Treasury issues new T-bills, notes, and bonds to investors like you and me, the U.S. Treasury gets new money in their coffer from us. They then use this new money to pay off old maturing debt held by existing debt holders. And the debt ceiling remains effectively unchanged so long as the amount of new debt issued by the U.S. Treasury remains the same or below the amount of old maturing debt that is being paid out. Now, let's take a quick look at the results from the latest Treasury auction of the 4-week and 8-week T-bill. These auctions happened literally on the day that we hit the debt ceiling on January 19th. Business as usual, and the yields were slightly up from the previous week. I don't think we can read too much into this one data point right now, given that we're still in the very early stages of this current debt ceiling crisis. In fact, Congress is just resuming session again this week. Plus, we are in an environment of continuing rate hike expectations. But as I mentioned earlier, I will keep watching events as they unfold and keep you posted. Which leads me to, am I buying new issue T-bills at auction with maturities past May? And how I make sense of all these charts. Yes, that's what I'm planning to do now, based on the information I have and my personal investment strategy. Everyone's financial journey is different, but for me, when my T-bills mature in the coming weeks and months, my plan is to keep laddering 17-week T-bills even if the maturities go beyond May at some point. Now, that's assuming that I can deal with no auto roll on the 17-week. If I can't, and not having auto roll becomes too much of a hassle for me, I may switch back to the 13-week T-bill. As we've seen from these charts, shorter-term T-bills stay relatively stable, and with the T-bill ladder that we've parked some of our emergency savings in, that's what I value, stability, along with liquidity. And also, well, because the Fed just came out again with the commitment to keep raising rates. From Federal Reserve Governor Lael Brainard's speech a few days ago, and I quote, "Even with the recent moderation, inflation remains high, and the policy will need to be sufficiently restrictive for some time to make sure inflation returns to 2% on a sustained basis." Now, as we get closer and closer to the Treasury's June date of when their funds will be exhausted, if history repeats itself and these long-term Treasury prices do go up as they have in previous debt ceiling crises, it's difficult to say how or whether the Fed's planned rate hikes will dampen some of this impact. For those of you trading larger volumes who might be eyeing potential market opportunities, if, even during a rising interest rate environment, this pattern of rising prices on longer maturity treasuries does happen as the political battle over the debt ceiling drags on in Washington, I could see a scenario where you might be able to make some money potentially by selling off the longer maturity treasuries you own when the prices go up. And for those of you who own longer term treasuries and are planning to hold to maturity, remember that these are market prices. If you hold to maturity, these market prices should not impact your interest or principal payments. And finally, for those of you who might have been thinking about this right here, if it occurs this time again, this dip could present some buying opportunities in the stock market. Who knows, if the market drops enough, I might be moving some funds out of my other T-bill ladder, the one that's in my retirement account, back into equities. Although I'm personally not a huge fan or practitioner of trying to time the market. So another possibility for me might be longer term treasuries if the Fed raises rates high enough. Exciting times, so stay tuned for more as always. All right, Super Saver, I hope this video helped answer some of the more pressing questions you reached out to me about regarding hitting the debt ceiling and the impact that has on Treasury securities. This is a genuine concern given all the I-bonds, T-bills, notes, and bonds that we collectively own in this community. And my goal is to help you discern fact from fiction as you go through some of the fearful headlines that have appeared and that will probably continue to appear in the coming weeks and months, as well as to provide you with the best information and analysis I possibly can so that you can make as informed a decision as you possibly can about your money. And if you're still concerned after all this about a possible US default, I hope these assurances on the day that we hit the debt ceiling may help you sleep better at night. In this communication to the public, McConnell goes on to say that he expects some kind of negotiation with the administration over what the circumstances or conditions are under which the debt ceiling will be raised, and that a resolution will come sometime in the first half of 2023. So yes, it will most likely take a while until this comes to an end. We may see another partial government shutdown, but no, even though there are no guarantees, the markets and I do not price in an actual likelihood of a default by the US government at this point. Now, if you're not concerned and interested in taking advantage of the Fed's planned interest rate hikes by adding some Treasury securities to your portfolio, then check out our playlist here on T-bills and how to buy them. And as always, if you enjoyed this video, then don't forget to share it with those you care about. And of course, hit that thumbs up and see you again very soon with another brand new wealth building video.